Welcome to the December edition of the CSEE news broadcast by PropTech Bulgaria with very specific data on several real estate class types in 6 European countries from the CEE region: Bulgaria, Romania, Poland, Czechia, Slovakia and Hungary. Today we will focus our attention on the industrial and logistics asset class, and you can find on our YouTube channel or on seeproptech.eu our reports on and December edition of news on office, retail and residential asset classes too. Firstly, today we will focus our attention on a recent report by Cushman & Wakefield Global Manufacturing Risk Index. The Cushman & Wakefield Manufacturing Risk Index, or MRI, brings together a range of important indicators to assess the relative attractiveness amongst 45 countries in EMEA, the Americas and Asia-Pacific as locations of production. Countries are assessed based on 3 key areas: conditions, such as business environment, including the availability of talent, labor, and access to markets. Secondly, costs, inclusive of operating costs, such as labor, electricity, and real estate. And thirdly, risks, political, economic, and environmental. As you can see in the figure next to me in the baseline scenario, countries from our region, from the CEE region, which are in top quintile, Poland, Czech Republic and Slovakia, closely followed by Bulgaria, which falls in the second quintile together with Romania. Greece remains in the third quintile out of 4. In EMEA, many countries in Europe have suffered from an increase in economic risk as the challenges around security of energy supply threaten to negatively impact economic prospects in the near term. This, along with high electricity costs and labor costs, particularly as a lack of staff availability, has pushed wages for workers higher and has meant countries such as France, the Netherlands and Spain have suffered falls in their rankings this year. How swiftly these increased costs and heightened risk challenges will be resolved will make a significant difference to the competitiveness of many European countries as production locations in the near term. However, considerations about location choices for manufacturing operations are becoming somewhat more nuanced than just a cost of production story. This is very important to know, and I'm glad that the authors of this index have outlined it explicitly. The index is formed based on rough criteria and does not reflect nuanced conditions, which of course can favor some countries compared to others. So we may take the results of this index only as rough rating. We go on further with what the authors say about this report. Length, security and resiliency of supply chains are now playing an increasingly important role in decision-making for manufacturers. The challenges of supply chain disruption and the risk of business interruption are fueling companies to consider nearshoring production to locations more proximate to markets of consumption. This is a trend that we see and observe not only since 2022, but even before 2020. It was much fostered and speeded up by the COVID crisis, but the nearshoring trend of Western European countries moving production facilities to CEE countries is going on even before 2019. And whilst costs remain important to overall considerations, businesses are shifting their perspectives around what constitutes key determinants of risk and security. As a result, European and Mediterranean locations that can demonstrate strong credentials on cost but are also closer to end destination markets, and especially where they can offer access to approximately skilled labor and reliability of energy supply, will continue to enjoy opportunities to capture demand for production facilities, either as primary sites or as complementary sites to those in further away locations. In the next scenario, the cost scenario, we see that only Poland, and it is last in the top quintile, closely followed by Bulgaria. Next comes Slovakia, Hungary, Czech Republic, and Romania. Greece again ranks in the third quintile. Whilst energy costs have risen in Poland, the rates are still lower than in other nearby lower-cost locations such as Lithuania, Romania, Bulgaria, and the Czech Republic. Energy costs will remain a key issue for European markets, which are more exposed to higher price levels and heightened volatility due to the challenges around securing fuels, particularly natural gas. And in the third scenario, the risk scenario, we see that Czech Republic and Poland rank in the top quintile, followed by Slovakia and Bulgaria in the second, and Hungary, Romania in the third. Greece in this scenario is nearly last but one in the fourth quintile. Countries in Europe typically enjoy some of the world's lowest geopolitical risk profiles, but many are currently facing heightened risk levels, particularly economic and political, as the challenges of the regional and global dynamics impact individual countries. For some, including Czech Republic and Poland, improvements to the country's capabilities achieving sustainability targets, along with highly competitive cost profiles, have helped to bolster their position in the rankings despite elements of heightened economic risk. As we shall see further on in our news when stating the data per each country, you will be able to see how these very rough and aggregate conclusions are either true or false for each country. For others, such as Finland, Sweden, Germany, and Austria, their strong credentials as stable, transparent countries have meant that despite some degree of increased economic risk in particular, they remain amongst the highest ranking countries globally. For others, such as Denmark and the Netherlands, raised economic risk levels coupled with higher costs and more challenging labor market conditions have meant that their rankings this year have slipped, but as with many European countries, improvements to the economic and political risk conditions will likely return them to their positions further up in the rankings in the years ahead. As we can see from this Eurostat graph, the industrial production in August 2022 in percentage as a change compared with August previous year, 2021, we see that Bulgaria ranks first with the highest industrial production in whole Europe. Next is Lithuania, Denmark, Malta, Poland, Hungary, Ireland, Czechia, and Spain, and Austria. This is a graph that we included just to showcase our observation that each report presents things from one standpoint. Such criteria in comprising the manufacturing index of Cushman and Wakefield is based not only on data but also on some subjectivity of criteria. That's why it's important to juxtapose and to compare and to compile overall data from many other sources in order to get the right impression about the situation in each country. Following the graph, we continue with particular specific data country by country, and we start this time with Slovakia. The industrial sector did everything but slow down. Once again, it exceeded expectations and kept growing at a rapid pace due to the delivery of 113,500 square meters split into 5 buildings across all regions. Another 21 buildings with a total area of 305,900 square meters are underway. Speculative construction accounted for 45% of the development pipeline, indicating that developers are more prone to commence build-to-suit projects. In addition, the build-to-own concept is gaining interest among developers. In this quarter, Q3 2022, the growth rate of construction material costs slowed down and their availability improved, allowing developers to deliver new assets in no more than 12 months. Despite the uncertain situation and rows of headlines in almost all submarkets, we are witnessing ongoing high demand, driven by the need to secure the production and supply of car parts and components. Demand consists mostly of 3PL and the automotive sector. Therefore, take-up even surpassed the previous quarter and amounted to 204,800 square meters, representing a 154% increase over the 5-year average of the same quarter. Net take-up figures of 161,900 square meters, or 79% of total leased space, illustrate strong interest in new spaces. Consequently, the vacancy rate was pushed down over 2 pp quarter to quarter to a value of 3.15%, implying market cycles have shifted from tenant to developer market. A combination of increased construction costs, elevated energy prices, unceasing demand, and low vacancy resulted in a substantial increase in headline rents across submarkets. Subsequently, prime rent rose to 4.25% euro per square meter per month. Further rent growth is not only possible but inevitable. It is backed by numerous ongoing deals on both existing and future development. In general, developers search for new opportunities for land acquisitions to ensure the growth of their portfolio for the next period. Despite upward pressure on yields, prime yield remained at 4.25%, with the possibility of growth in Q4 2022. In the third quarter of 2022, the total stock of modern industrial and logistics premises of Class A in Slovakia reached more than 3,575,000 square meters. There is 278,212 square meters under construction, 48% of which are located in the Bratislava region. The tenants' demand for vacant premises is still higher than the supply. Next, we move on to Czechia. Inflation and the energy crisis have not influenced the Czech industrial real estate market yet, as the market broke 2 historical records in the period of Q3 2022. More than 500,000 square meters of new industrial space was completed, and the vacancy rate fell below 1% for the first time in recorded history, says the newest GLL report. A total of 511,100 square meters of warehouse space was completed during Q3, but 36% of this was a single home built by Amazon. The total volume of modern industrial space reaches 10.65 million square meters. The volume of projects under construction has been above 1 million square meters for 4 consecutive quarters. Specifically, nearly 1.60 million square meters was under construction at the end of Q3. Of that total amount, only 65% had a secure tenant. Last year, this ratio was around 75%. A significant share of this volume of projects under construction accounts for 233,700 square meters home being built by Panattoni near Chep for an undisclosed distribution company. The greatest demand is traditionally around large cities, especially Prague, but the small number of projects that have secured the necessary permits to start construction is a barrier to construction there. The Central Bohemian region, which has always been a cheaper alternative to Prague warehousing, does not offer many A-class opportunities. Increasingly, tenants are reverting to more distant locations in the Central Bohemian region, such as Kladno, Ždice and Ostrodek. In Prague and its surroundings, the vacancy rate was just 0.6% at the end of Q3 2022. However, this vacancy rate also includes office components within industrial sites, and GLL modeling suggests that the overall industrial vacancy rate would be close to zero if we exclude these office components. Robert Sgariboldi, director of the industrial leasing department at GLL, says such a low vacancy rate across the Czech Republic is not good news for the occupier market. Many tenants are currently dealing with a lack of space for their businesses. The inability to expand within a 6-12 month period is a limiting factor for the growth of their business, even if they're willing to relocate part of their operations to border regions where partial vacancy and the possibility of flexible expansion still existed in the last quarter. Therefore, tenants must consider their expansion plans at least 18 to 24 months in advance, or alternatively to move in other CEE countries such as Slovakia or Bulgaria. Outside of transactions with undisclosed tenant, logistics companies accounted for the largest share of net demand at 42%, followed by manufacturers at 31% and distributors at 23%, which very clearly showcases that Czech Republic and to a certain extent also Poland and Romania, as we will see in their figures, shape up as logistic hubs from certain regions to Western Europe, and this is why this speed ups this high demand for logistics space in these countries. The highest achieved rents for warehouse and industrial space were 6 to 7.5 euro per square meter per month in Q3 2022. Rents in the Prague region and surroundings were in some cases offered at 8.5 euro per square meter per month. A total of 18 new buildings were completed in Q3 2022. The largest completed space was the 186,800 square meter space for Amazon at Panattoni Park, Kožetin. This was followed by 56,900 square meters hall in CT Park, Bor, for GXO Logistics. The third largest completed project was 27,900 square meters hall in the new industrial park P3 Ostrava Central, which has been only half leased to 3 tenants so far. Further, we move on to Romania. In Q3 2022, around 627,837 square meters of warehousing space was transacted, more than a third of which, 36%, being occupied by retailers. Logistics and e-commerce were next, with the shares of 11 and 9% respectively of the signed contracts. In the first 9 months of the year, gross demand was up 68% compared to the same period in 2021, reaching 881,400 square meters. In Q3, 282,100 square meters of space was delivered, a threefold increase compared to the previous quarter, bringing the modern industrial stock in Romania to a total of 6.3 million square meters, half of which are in Bucharest and its proximities. National vacancy rates increased from 2.6 to 4%, according to GLL Romania data. Retail and distribution companies have been the most dynamic across the leasing market, as these companies continued to expand both online and offline. There is a market dependence on the retail sector in Romania, and definitely the retail sector in Romania is the highest occupier of industrial logistics space in the country. The contribution of private developers investing in their cargo or intermodal terminals is very important and will generate new opportunities for companies interested in operating production logistic facilities on the territory of our country, said Victor Răcită, Head of Industrial and Logistics at CBRE Romania. In the first 3 quarters, deliveries of new spaces totaled 525,000 square meters, while another 570,000 square meters are under construction. Bucharest benefited from 56% of the newly built spaces, developers being also active in Brasov, Timișoara and Cluj. Headline rents registered a slight increase this year, reaching 4.5 euro per square meter, 0.50 euro per square meter per month at the end of Q3. Storage continues to be the main activity for which spaces are leased, while production activities cover only 8% of the spaces. The Romanian self-storage market has reached a leasable area of 25,000 square meters in 2022, which was just 0.2% of the total European market, according to real estate consultancy CBRE. Locally, 43% of the self-storage units are leased by individuals, while the rest is covered by corporate clients. At the same time, the self-storage average rent in Romania is 126 euro per square meter per year, the second cheapest rent in Europe after Latvia, with 96 euro per square meter per year. While the average rent in Europe is 290 euros per square meter per year. The self-storage market all over Europe has had a record 2021 year, as total investment volumes reached 650 million euro, which was up 3.5 times more than in 2020. In the past 5 years, the number of facilities has increased by 70%, amounting to over 5,400 facilities with approximately 11.5 million square meters of lettable floor space in all European countries. With almost 40% market share, the United Kingdom is the market leader in terms of stock, followed by France and Spain. And the next country we will pay attention to is Poland. SEE expands its activities in the development of logistics properties to the international market and realizes logistics projects in Poland for the first time. SEE's first international logistics center is being built in Wrocław, around 25 kilometers from Wrocław, and located directly on the A4 freeway in the direction to Dresden. It will offer a logistic area of around 80,000 square meters and will be tailor-made to meet the requirements of future users. Construction is scheduled to start in November 2022 and to be completed in fall 2023. BTS built-to-suit warehouses designed and constructed for long-term occupancy in line with individual client preferences and needs account for almost a third of Poland's total industrial stock, or over 8 million square meters. In Poland, the largest have been delivered for e-commerce giants such as Amazon in Gliwice, Świebodzin and Szczecin, and Zalando in Szczecin and Bydgoszcz. Leading retailers and logistics companies are also investing in BTC projects. Leroy Merlin in central Poland, DHL in Żerniki, and Żabka in Radzymin. BTS warehouses are very popular with logistics companies and retailers, and e-commerce in particular, where time is very of high importance and is crucial. That's why locations with convenient transport connections and proximity to motorways or expressways are clearly favored. Another important aspect is the possibility of having a facility tailored to individual needs and technical solutions put in place to optimize picking, packing, shipping and returns management. BTS construction is a time-consuming process. Not only does it require securing land in the right location for the tenant, but also utility connections and mandatory permits, as well as assessing the environmental footprint of a facility, delivering the project itself and obtaining an occupancy permit. And finally, we move on to Hungary. The industrial and logistics market is extremely active. The foreign direct investments remain which enter Hungary, and we experience expansion in the manufacturing fields of logistics. 32% of the disclosed transactions arise from the new entries investing in the Hungarian market. There were 170,000 square meters of new leases signed in Q3, which is equivalent to the previous year's average annual volume. In Q3 2022, the speculative industrial stock in Greater Budapest was expanded by 8 buildings, a total of 145,390 square meters, while 4 new buildings were handed over in regional Hungary with a total of 43,380 square meters, Budapest Research Forum reports. The stock in Greater Budapest reached 3 million square meters, while further 1,413,000 square meters of space is located in regional Hungary. The largest new building in Q3 was City Park Vestic, VCS3, with 32,690 square meters. In Park Gyula 1 was handed over with 13,580 square meters. The vacancy rate at the end of Q3 2022 stood at 4.9% in Greater Budapest. At the end of the third quarter, a total of 148,400 square meters logistics area stood vacant, and there were 8 existing schemes that had availability of more than 5,000 square meters. In regional Hungary, there was 60,670 square meters of vacant space, which equals 4.3% vacancy rate. Total demand in Greater Budapest amounted to 218,220 square meters in Q3 2022, indicating a 52% increase in the volume measured in the corresponding period of the previous year. Take-up, excluding renewals, added up to 170,680 square meters, which marks more than 2.5 times the higher volume that was registered in the same period last year. New leases dominated the demand with a share of 72%. Renewals accounted for 22% of gross take-up, while pre-leases and expansions both reached a 3% share. 36 leasing transactions were recorded in Greater Budapest in Q3 2022, with an average transaction size of 6,060 square meters. 6 of them were signed for more than 10,000 square meters. The majority of these leases were still signed in big box logistic parks, as the city logistic stock registered only 2 agreements. The largest transactions in the quarter were new leases, one in City Park Budapest West BIA 4 with 28,000 square meters, and one in Prologis Park Budapest Ziget DC5 with 20,000 square meters. Quarterly net absorption in Greater Budapest was 187,330 square meters in Q3 2022. So, These were our news, December edition of the SE News on the industrial asset class. Check also our news on residential, office, and retail.